How to start investing in cryptocurrency, a guide for beginners. Cryptocurrencies have been enormously volatile since being introduced, but that volatility can create opportunities for profits if you're looking to trade these digital assets. Crypto such as Bitcoin and Ethereum has risen a lot since their debut, but are down significantly from their highs along with other popular digital currencies. Experienced traders have been speculating on cryptocurrencies for years, but how can you get started if you're new to the crypto market? Here's how to start investing in cryptocurrency and the significant risks you need to watch out for. 5 steps for investing in cryptocurrencies. First things first, if you're looking to invest in crypto, you need to have all your finances in order. That means having an emergency fund in place, a manageable level of debt, and ideally a diversified portfolio of investments. Your crypto investments can become one more part of your portfolio, one that helps you raise your total returns, hopefully. Pay attention to these 5 other things as you're starting to invest in cryptocurrencies. Number one, understand what you're investing in. As you would for any investment, understand exactly what you're investing in. If you're buying stocks, it's important to read the annual report and other SEC filings to analyze the company thoroughly. Plan to do the same with any cryptocurrencies since there are literally thousands of them, they all function differently and new ones are being created every day. You need to understand the investment case for each trade. In the case of many cryptocurrencies, they are backed by nothing at all, either hard assets, neither hard assets nor cash flow of any underlying entity. That's the case for Bitcoin, for example, where investors rely exclusively on someone paying more for the asset than they paid for it. In other words, unlike stock, where a company can grow its profits and drive returns for you that way, many crypto assets must rely on the markets becoming more optimistic and bullish for you to profit. Some of the most regular coins include Ethereum, Dogecoin, Cardano, and XRP. So before investing, understand the potential upside and downside. If your financial investment is not backed by an asset or cash flow, it could end up being worth nothing. Step 2, remember the past is past. A mistake that many investors make is looking at the past and extrapolating that to the future. Yes, Bitcoin used to be worth pennies, but now is worth much more. The key question, however, is will that growth continue into the future? Even if it's not quite at a meteoric rate, investors look to the future, not to what an asset has done in the past. What will drive future returns? Traders buying a cryptocurrency today need tomorrow's gains, not yesterday's. Watch that volatility. The prices of cryptocurrencies are about as volatile as an asset can get. They could drop quickly in seconds on nothing more than a rumor that ends up proving business. That can be great for sophisticated investors who can execute trades rapidly or who have a solid grasp on the market's fundamental, how the market is trending and where it could go. For new investors without these skills or the high-powered algorithms that direct these trades, it's a minefield. Volatility is a game of high-powered Wall Street traders, each of whom is trying to outgun other deep-pocketed investors. A new investor can easily get crushed by the volatility. That's because volatility shakes out traders, especially beginners who get scared. Meanwhile, other traders may step in and buy on the cheap. In short, high volatility can help sophisticated traders buy low and sell high, while inexperienced investors buy high and sell low. Manage your risk. If you're trading any asset on a short-term basis, you need to manage your risk. And that can be especially true with volatile assets such as cryptocurrency. So as a new trader, you need to understand how best to manage risk and develop a process that helps you mitigate losses. And that process can vary from individual to individual. Risk management for a long term investor might simply be never selling regardless of the price. The long-term mentality allows the investor to stick with the position. Risk management for a short-term trader, however, might be setting strict rules on when to sell, such as when an investment has fallen 10%. The trader then strictly follows the rule so that a relatively small decline doesn't become a crushing loss later. Newer traders should consider setting aside a certain amount of trading money and then using only a portion of it, at least at first. If a position moves against them, they will still have money in reserve to trade later. The ultimate point is that you can't trade if you don't have any money. So keeping some money in reserve means you always have a bankroll to fund your trading. It's important to manage risk, but that will come at an emotional cost. Selling a losing point, selling a losing position hurts, but doing so can help you avoid worse losses after. Don't invest more than you can afford to lose. Finally, it's important to avoid putting money that you need into speculative assets. If you can't afford to lose it all of it, you can't afford to put it into risky assets such as cryptocurrencies or other speculative assets for that matter. Whether it's a down payment for a house or an important upcoming purchase, money you need in the next few years should be kept in safe accounts so that it's where you need it. And if you're looking for an absolutely sure return, the best option is to pay off debt. You're guaranteed to earn or save whatever interest rates you're paying on the debt. You can't lose them. Finally, don't overlook the security of an exchange or broker you're using. You may own the assets legally, but someone still has to secure them, and their security needs to be tight. If they don't think their cryptocurrency is properly secured, some traders choose to invest in a crypto wallet to hold their coins offline so they are inaccessible to hackers or others. Other ways to invest in cryptocurrency. While investing directly in cryptocurrency may be the most popular way to do so, traders have other ways to get into the crypto game, some more directly than the others. These include crypto futures. Futures are another way to wager on the price swings in Bitcoin, and futures allow you to use the power of leverage to generate massive returns or losses. Futures are fast-moving markets and exacerbate the already volatile moves in crypto funds. A few crypto funds such as Grayscale Bitcoin Trust also exist that allows you to wager on the price swings in Bitcoin, Ethereum as well as other altcoins. So they can be an easy way to buy crypto through a fund-like product. Crypto exchange or broker stocks. Buying stock in a company that is poised to profit on the rise of cryptocurrency, regardless of the winner, could be an interesting option too. And that's the potential on an exchange such as Coinbase or a broker such as Robinhood, which drives a huge chunk of its revenues from crypto trading. Blockchain ETFs. A blockchain ETF allows you to invest in companies that may profit from the emergence of blockchain technology. The top blockchain ETF gives you exposure to some of the key publicly traded companies in the space, but it's important to note that these companies often do much more than crypto-related businesses, meaning your exposure to cryptocurrency is diluted, reducing your potential upside and downside. Each of these methods varies in its riskiness and exposure to cryptocurrency, so you want to understand exactly what you're buying and whether it fits your need. Cryptocurrency investing frequently asked questions. How much money do I need to start investing in cryptocurrency? In theory, it only takes a few dollars to invest in cryptocurrency. Most crypto exchanges, for example, have a minimum trade that might be $10 or $5. Other crypto trading apps might have a minimum that is even lower. However, it's important to understand that some trading platforms will take a huge chunk of your investment as a fee if you're trading small amounts of cryptocurrency. So it's important to look for a broker or exchange that minimizes your fee. In fact, many so-called free brokers embedded fees called spread markups in the price you pay for your cryptocurrency. How does a blockchain work? Cryptocurrency is based on blockchain technology. Blockchain is a kind of database that records and timestamps every entry into it. The best way to think of a blockchain is like a running receipt of transactions. When a blockchain database powers cryptocurrency, it records and verifies transactions in the currency, verifying the currency's movements and who owns it. How do I mine cryptocurrency? Some cryptocurrencies reward those who verify the transactions on the blockchain database in a process called mining. For example, these miners involved with Bitcoin solve every complex mathematical problems as part of the verification process. If they are successful, miners receive a predetermined award of Bitcoins. How can I invest in cryptos? Some ways you can invest in cryptos are crypto exchanges, which are one of the widest selection of cryptocurrencies, and they tend to be the most competitive on price. Traditional brokers. Many traditional brokers also allow you to trade Bitcoin in addition to stocks and other financial assets, though they have a relatively limited selection of other cryptocurrencies. Financial apps. Many financial apps now allow you to trade Bitcoin and a few cryptos. Top players here include Robinhood and Weibo. What are altcoins? An altcoin is an alternative to Bitcoin. Many years ago, traders would use the term pejoratively. Since Bitcoin was the largest and most popular cryptocurrency, everything else was defined in relation to it. So whatever was not Bitcoin was lumped into a derisive category called altcoins. Bottom line, cryptocurrency is a highly speculative area of the market, and many smart investors have decided to put their money elsewhere. For beginners who want to get started trading crypto, however, the best advice is to start small and only use money you can afford to lose.